Over the last 100 years, investors have always been paid to buy value over growth, but there have been periods where growth outperforms value. And we are in a very extended period of growth outperforming value. I think a lot of new investors, last 10, 15 years, why would you ever buy value? Growth is the only place to be at. And you go back 100 years, and if you look at some of those graphs, this isn't looking good for growth. They've had an extended run. Value is going to take its place back on the throne again.
We've been talking about this return to value for the last few years, and it hasn't happened yet because there's been such this chase for growth, talking about the number of ETFs that are being issued. And the ramp up in ETFs being issued, again, is just kind of symptomatic of where we are in this market. And you've just seen, particularly since 2021, this very rapid increase in the number of ETFs being issued. And the vast majority of these ETFs are in leveraged equity, option strategy, cryptocurrency. That's been a big chunk of, and this is just in the month of November. This is what was launched in November, so not all year, that were all very high risk, high beta type trades. And that's not surprising. But again, on that list, no value. So value's been out of vogue. Nobody wants it. Maybe that's the time that you start looking at, hey, maybe I add a little bit of value to my portfolio. You don't shift your whole portfolio from growth to value, because right now growth is still intact. But maybe this is where you start kind of fishing around the edges, adding a little bit of value, adding a little bit of defense, because when the market does rotate, it'll act as a hedge for your portfolio because money will gravitate towards value out of growth. But it could be kind of, if we do get a reversion of that cycle where value does eventually start to outperform growth, that could serve you very well. I'm going to do some more analysis on this, but I've done this before. Took the CAPE PE, which is the cyclically adjusted PE ratio by Schiller, which uses 10-year trailing returns. And I've cut that down to 5 because it's more market sensitive. So I call it the CAPE 5 ratio. But that CAPE 5 ratio is more sensitive to market dynamics, which is extremely overvalued right now. But this is just showing you what the expected rate of return for the next 5 years based on current. And this is forward PEs, by the way. So this is even the most optimistic outlook for earnings. You're looking at very potentially low rates of return. Again, that doesn't mean low rates of return every year at all. It means that probably somewhere within the next 5 years, you're going to get a 20 or 30% down market somewhere. And then markets are going to rally back and you're going to have a zero rate of return over 5 years. But in that type of environment, if that would turn out to be the case, if the historical trends of 5-year valuations are accurate, that having some value and defense in your portfolio over the next 5 years could be very beneficial to helping you survive what the market provides.
Catch me daily on The Real Investment Show. The link is in the description.